We have a top at around 200 ounces for the Dow. We're now at 182, and this is going to deflate, meaning silver is going to rise relative to the S&P 500 and the Dow. It's pretty much the same chart if you look at the Dow also. And whether that means silver is going to rise parabolically or the S&P 500 is going to fall, or crash or something, it really makes no difference for silver stackers. Either way, you gain the same amount of purchasing power. Silver has not followed gold. So this is a specifically gold stretch in open interest up to 600,000 contracts, 610,000 contracts. Something is happening in the banks, and banks are the ones that really trade gold derivatives. Silver derivatives are not really hoarded that much by banks. Gold derivatives are driven by the bullion banks and the bullion bank cartel.
Renowned financial expert Rafi Farber discusses historical shifts in silver to stocks ratio, noting a period of stock market dominance from pre-depression to the Nixon era. He anticipates a potential turnaround, suggesting silver could gain against the S&P 500 and Dow. While Farber emphasizes silver's advantage for preserving purchasing power, regardless of whether it rises sharply or stocks decline. Investors looking beyond red-hot equities could consider buying silver, which could outperform various asset classes over the next 12 to 15 months. Silver prices are expected to firm up over the next year or so due to growing demand for industrial metal, an expected recovery in China, and a likely interest rate cut by the U.S. Federal Reserve. From a technical standpoint, Farber notes China's consistent gold purchases since 2015, which is the longest streak since 2000. He suggests these purchases, though unlikely to impact the yuan directly, reflect broader concerns about a dollar shortage in the U.S. and its implications globally. The Japanese yen now looks remarkably cheap, with bond yields finally rising to levels that might attract international buyers. Even the sterling still accounts for a larger share of global foreign currency reserves than China's renminbi. The pool of investable assets in China itself remains small. The scope to evade sanctions by diversifying out of the dollar is also limited by the likelihood that allies of the U.S. would coordinate their response to a new threat from China, in the same way they did to Russia's invasion of Ukraine. The gold market is simply not large enough to absorb all of the capital that China has parked overseas. Transitioning to economic indicators, Farber discusses the significance of the SOFR rate, particularly its spike to 5.5% in September 2019, which he refers to as a financial apocalypse. He cites evidence from various analysts, indicating a dollar crunch reflected in tightening repo markets, especially noticeable outside typical month-end fluctuations. Now we present the clips of Rafi Farber's insights from his recent interview. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
Silver, I wanted to give a little bit of a perspective here, going back to about 1928, 1930. This is silver relative to the S&P 500. So we see here from about 1928 to 1972, right? That's this area over here. This, let's say here is around 1928, before the crash of 29. Silver relative to stocks. The higher this is, the lower silver is relative to stocks. So bubble territory from about 1928, just before the Great Depression, until about 1972, just after the closing of the Nixonian gold window. Bubble territory for stocks relative to silver was around 65, 70 ounces to the Dow. After 1980, we went from, what is that? I don't even know what that number is. Maybe 5 or 10 or something. It looks like 5, maybe even less, 3, 2. I can't even read that number. You can look at the number yourself, look up the data. You can pause the video here and look it up for yourself. It's a very, very low number, all-time record low. And we go up to about 300 ounces for the S&P 500. And we only go below the 1928 to 1972 bubble territory in the 2011 parabolic top here. But we can see here that silver has been very volatile, or really stocks. If you can say silver's been volatile, you can say stocks have been volatile. Either one, whichever perspective you want to take here, it's been pretty volatile, and this looks kind of toppy to me. Right? We have a top at around 200 ounces for the Dow. We're now at 182, and this is going to deflate, meaning silver is going to rise relative to the S&P 500 and the Dow. It's pretty much the same chart if you look at the Dow also. And whether that means silver is going to rise parabolically or the S&P 500 is going to fall, or crash or something, it really makes no difference for silver stackers. Either way, you gain the same amount of purchasing power. So I just wanted to show you where we are here relative to stocks. Let's go to the next chart. I'm going to show you this little slide here, and then we're going to go into the interactive chart on Fred, just so you can get an idea what I'm saying. So this is the SOFR rate. That's the rate, basically the repo rate. This is what went to 5.5% overnight on September 17th, 2019, the repocalypse. And this is how I'm judging what is going on in the plumbing of the financial system. And so I said that evidence from Brian Kuzmar of Fort Lauderdale Precious Metals, Gold and Silver Precious Metals, I think the store is called. He doesn't even have a website. He's a very old-fashioned guy. So he was saying again about making his profit margins on the sale of numismatic collections rather than the sale of bullion at this point in time. And we can see here that this evidence of a dollar crunch is being reflected in the repo markets, because I'll show you this on the interactive chart in a second, that the SOFR rate, the repo rate, is getting very wobbly, specifically not around monthly ends. At month ends, the repo rate goes up because banks balance their books and for other regulatory reasons. But now it's getting wobbly outside of month ends. And this suggests to me that the repo market is getting very tight. In the meantime, China is accumulating gold at its most sustained pace going back to 2000. We see here that there were bursts of gold purchases and sustained gold purchases from 2015 to about 2017, 2016, whatever that was. But now we have sustained gold buying every month. This is the longest streak of gold buying monthly by the People's Bank of China. And I don't think this has any impact on the yuan, really, because if the yuan does collapse, and it will collapse with the dollar because the yuan is a derivative of the dollar, then what happens is that the trust in the yuan is lost, and the only way it can get regained is if it becomes convertible to gold, which I don't think the Chinese bank wants to do. So it will affect the price of gold, but I don't think it will affect faith in the yuan or their fiat currency system. And so the point here, my friends, this week is that I see evidence of growing dollar crunch in the US, and it is being reflected in China, the main trading partner. We're getting close. We're seeing it in the plumbing. We're seeing it on the front end, according to Brian Kuzmar, with my interview, which should be up next week, early next week on my channel, Rafi Farber. Check it out on YouTube. And we're seeing it in the plumbing. We're seeing it in different directions, and it's coming. It could be weeks. It could be months, but it is on the way. Axiomatically, that must be the case because QT continues.
During the interview, Rafi Farber expressed concerns about the gold futures market, noting that open interest has surged to 609,360 contracts. He compared this to the March 2022 nickel Armageddon, which preceded a significant gold sell-off. He pointed out that this increase is driven by banks, not the physical markets or ETFs, and could lead to a dollar liquidity crunch. Open interest for precious metals, including gold, posted their first gain in roughly 4 weeks, says J.P. Morgan Global Commodities in a note, driving the $3.73 billion uptick to roughly $182 billion indicates that precious metals have room to rise, with the outlooks for gold and silver expected to improve in the coming weeks. Regarding the gold futures market, Farber suspects unusual banking activity and warned of a potential liquidity crunch. Farber advised against leverage, predicting a short-term dip in gold futures, but stability in physical markets. Let's get back to the interview.
I said last week that the gold futures market is making me a bit nervous. Not that I don't trust the rally, but these numbers are hinting to me that we're going to have a smash down in gold specifically. I don't know exactly how silver will react, but I've seen these numbers before in open interest, and it suggests that we are also on the cusp of some kind of liquidity crunch. I don't know how extreme it will be, but just to show you why I think that. So this chart is 1 day old. We are actually at 609,369 contracts for gold. Open interest at the bottom here. Now you can see that the last time we had open interest at this level was the March 7th, 2022 nickel Armageddon. And from there, we had a big sell-off in gold going down to the 1610 low. I'm not saying we're going to have a prolonged sell-off in gold at this point, lasting months or even half a year as it was from March to about September, October 2023. Don't think that's going to happen. But open interest has gone here from about 440,000 contracts just a few months ago, 2 or 3 months ago, to now 610,000 contracts. And this is all bank concentrated. This is not in the physical markets, and it's not in the ETFs. Something's going on in the banking system to encourage banks to open these positions. And the fact that so many contracts are now open means that a lot of dollar liquidity is tied up in the gold futures market, which could contribute to a dollar crunch. Now we see here back in 2019, 2020, that we went from about the same level, 440,000 contracts open, to an all-time record of 800,000 contracts. Gold open interest had never been that high. So we almost doubled open interest from 440,000 to 800,000 contracts in about 10 months or so, maybe less, 9-10 months. And we are up now 150,000 contracts in a very short amount of time. So something is going on in the banking system to encourage this hoarding of futures of gold derivatives. So basically what I'm saying is that when you have this amount of open interest, you want to be careful because something is going on in the banking system, not necessarily in the physical gold markets. So just stay careful here and be careful with your trading and don't be on leverage. I'm not on leverage. I'm never on leverage. And especially now is a dangerous time for it. So we'll see what happens with gold in the next few days to weeks. I expect a reset back down and a little bit of a hit in the price, at least in the futures market, but not really in the physical markets because premiums should compensate for any fall in the spot price. And I wanted to compare here. I did some stretching of the gold charts or US charts over here. So the numbers look a little bit unnatural as they are. I just wanted you to see the contrast here. This is gold open interest on the top. We're now at 609,000, so even higher than this number here, which is from yesterday. And in silver has not followed gold. So this is a specifically gold stretch in open interest up to 600,000 contracts, 610,000 contracts. Something is happening in the banks, and banks are the ones that really trade gold derivatives. Silver derivatives are not really hoarded that much by banks. Gold derivatives are driven by the bullion banks and the bullion bank cartel. So we'll see what they do in the weeks ahead, but it looks a little bit unstable.
At this point, silver markets are primarily driven by speculators, as industrial demand is stable. Unlike gold, silver does not enjoy support from central banks, which means that to make a strong move, silver markets must attract speculative investors. Given the current economic indicators and global trends, will silver outperform other asset classes in the coming year? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.